Welcome to our market commentary for the fourth and final quarter of 2020. Once again, the rollercoaster volatility has hit markets in the last quarter of this year. These wild swings are COVID related, but they mean a great deal more in terms of potential future challenges and opportunities. Global markets fell last month as they anticipated a blue wave outright Democrat victory in the US. This would likely have meant an unfettered regulatory and tax regime for capital markets. However, the close-run election meant a winner in terms of Mr. Biden with limited powers due to a Republican-blocked Senate. This has steadied markets. Within days, news of a viable vaccine broke, followed closely by a further vaccine announcement which sent markets around the world into recovery mode. In the US, China and Japan, markets have recovered their March losses and they now wheeze in towards the end of the year in reasonable shape despite a catastrophic year. In Europe, and especially here in the UK, the recovery story is somewhat delayed as markets await a resolution on a final trade deal between the two parties. The UK's FTSE 100 is still down this year by about 9.5% at the time of writing, although it did enjoy a turbocharged quarter, rising back up by about 7.6% from September until the end of November. Such fast gains do make great headlines, but it's easy to rise quickly from such a low point, and the index clearly still has a long way to go before it's repaired this year's damage. There's so much going on in markets currently, but there are two particular stories I'd like to bring to your attention. Firstly, let's talk about growth versus value. When we build a portfolio, we try to blend funds which invest in different styles to help long-term performance. Two well-known such styles are growth and value. A growth fund manager will seek out stocks that are already valuable but show potential to continue to grow because of a particular market trend. Tech stocks in companies such as Apple, Netflix and Zoom are good examples of growth strategies, and of course they've enjoyed a phenomenal year because of COVID. A value fund manager will seek out the unloved stocks that appear extremely good value and underpriced. A good example of this currently could be some of the companies in the UK, especially in the small and mid and even some of the large sector companies. Uncertainty over our trade position has caused these companies to become unpopular. But could this change? As a direct comparison for you, the Threadneedle American Select Fund rose by over 20% this year, whereas the Rathbone Income Fund, which is a UK equity fund, fell by over 8% this year. Now, both are solid funds, but they just have very, very different stories. This parallel universe can be quite daunting for some people, although we find it rather fun. However, our blended approach is really paying off in recent weeks, as we suddenly have noticed a surge in growth by those unloved value funds. More arrestingly, we're also noticing that the growth funds have taken quite a hit in recent weeks, as growth appears to turn to momentum. Now, this momentum investing is a very different approach. It's also known as greater fool theory, as it relies upon a greater fool than you to buy it. The first recorded instance of momentum investing was the Great Tulip Bulb Crisis of 1637. I wasn't there. When people were actually paying the price of a house for a single tulip bulb. Then the market crashed and a lot of people got caught out. It is easy, to argue that some tech stocks are entering this sort of territory. The second thing I want to briefly discuss is deal or no deal. There can be no doubt that the FTSE 100 is playing its tune to the sound of negotiation briefings as the end of the December deadline looms. Expect this to intensify. If a deal of some sort is reached, I think the midterm story for UK markets could be very positive. However, a no-deal scenario could damage UK gilts as confidence in our country could hit a new low. UK equities have already taken such a hit, so it's possible that losses may not be so pronounced, but obviously it's very, very hard to predict. We're currently watching the negotiations with interest, as our lower risk portfolios could really benefit from a Brexit deal, at least in the short to mid-term. Now, this has definitely been the toughest year ever to do my job. I know that many of our wonderful clients will also share this feeling in their own lives too. It's just not been an easy period. However, as we come to the end of 2020, I have to say I feel an immense sense of pride that all of our clients have gained very pleasing profits during such a shocking year. As ever, diligence and diversification has paid off. I really hope that you enjoy your December review. There are some changes in a few of the portfolios, so please do get back to me. And don't hesitate to contact me if you need anything at all. We're always here for you. I'll try and put another article out before the end of this year, but in the event of not seeing you before, I wish you all the best. Look after yourselves and have a peaceful and safe Christmas.